One, that financial markets don't reflect the underlying conditions accurately. They are always provide a distorted or biased picture. And second, that in certain ways and on certain occasions, that biased or distorted valuation can actually affect the so-called fundamentals that market prices are supposed to reflect. And that happens when the misconception actually reinforces a prevailing trend. And that leads me to a theory of bubbles, because I contend that every bubble has two components. It has a trend that actually is occurring in reality. And then there is a misconception or misinterpretation that has this effect of initially reinforcing both the prevailing trend and the prevailing misconception, which eventually reaches a point where it becomes unsustainable. The divergence from reality is just too blatant. And then you have a reversal. And that's how you have booms and busts. Perhaps the simplest case is connected with real estate, housing or other forms of real estate. And in fact, many bubbles have developed in real estate. And there, the underlying trend is an increased willingness to lend, and an increase in housing prices or real estate prices, which increases the value of the collateral, and together with an increased willingness to extend credit on that collateral to relax the conditions, you have a bubble which eventually becomes unsustainable. And the misconception there is that the value of the collateral is independent of the willingness to lend. And that is false, because actually there is this two-way reflexive connection between the value of the collateral and the willingness to lend. Now, the present situation, which was touched off by the housing boom, the US housing boom, you had this very simple housing boom going on. But behind it, I contend, there was a much larger super bubble that has been developing ever since, I would say, 1980. And the underlying trend that actually was occurring in reality is an ever-increasing use of credit and leverage. And that actually has been going on longer. It really started ever since the Second World War. But it's in 1980 that a misconception about markets became the dominant creed, which I call market fundamentalism. The belief that markets can correct their excesses and that markets should be given a free rein. And that helped to accelerate this credit extension, and initially was self-reinforcing. It manifested itself in globalization, the globalization of financial markets, which was actually very beneficial, particularly to the United States, but generally beneficial to the holders of financial assets, because it made it more difficult to regulate or tax financial assets, because they could move somewhere else. Secondly, you had deregulation, which then allowed financial innovation and engineering. And that was the third element, this explosion of financial engineering, which was, however, built on this false conception about markets that deviations are occur in a random fashion. And that's how you, and also the various risk management techniques that became very widely used were built on this false assumption. And now, this, because it's a false assumption, it led to crises, financial crises. And ever since 1980, in fact, we had a large number of financial crises in various segments of the world or segments of the market. But interestingly, of course, each time the authorities intervened and merged away the failing institution and provided fiscal and monetary stimulus whenever the crisis threatened to affect the real economy. So, interestingly, ironically, I would say, these occasional financial crises served as a successful test of the misconception that markets can be left to their own devices. So that's what allowed this bubble to develop as big as it did. Frankly, I thought it couldn't go this far. I thought that already in 97, 98 that the authorities might not be able to contain it, but they did. And then after that came the IT bubble and the lowering of interest rates, keeping interest rates too low, too long, which got the housing bubble going. So each time the way to deal with overcoming the crisis was to accelerate the use of leverage and credit. Until this time, it could not be contained. And it may not be fully realized, but actually the financial system did melt down. We had what Rubini calls a cardiac arrest. It didn't last very long because immediately it was resuscitated. But that came when Lehman was allowed to fail. And that brought one market after another to a complete standstill. A money market fund broke the buck. There was a run on money markets. The commercial paper market, where the money markets were the main customers, or a main customer, came to a standstill. And then you had the AIG thing. So within 3 days, the authorities had to reverse and actually throw moral hazard out of the window, because first thing is to keep the system going. That's the one thing we had learned in the 30s, that we must do whatever it takes to save the system. So actually, that was the turning point, because now we are willing to throw whatever money is necessary to keep the system going. The balance sheet of the Federal Reserve went from 800 billion